Morning, ladies and gents. Simon Brown here. No Dineo this morning, some technical issues, so I'm going to do this solo this morning. It'll be a little shorter because there's only just me, but nonetheless, we thought let's do it anyway. Just checking that you can hear me, that you can see my screen. If we get yays to both, if you can raise your hand, and then go to webinar app. Brilliant, hands coming aplenty. Start as always with our offshore part of the market and news out of the Congressional Budget Office. Now this is, as it suggests, Congressional Budget Office, US. This is the Senate and the Senate and the House. They essentially have a non-partisan budget office, which is staffed predominantly with civil servants. And they're talking around the estimate for 2020. They're looking at the US deficit around 3.1 trillion. It's about 15% of GDP. And take total debt for the US to 102% of GDP. And it's going through the 100% level for the first time since 1946 that the US has had more debt than they've had GDP. In essence, your balance sheet, right? Your GDP, I suppose, is your assets, your debt is your liabilities. It means the US is technically bankrupt. Now, last time in 46, of course, they'd just come out of a world war, and that kind of maybe made a bit of sense. This time, I suppose, we have come out of 12 years apart, two crises. One, the financial crisis of 08-09, and then, of course, the current pandemic of 2020. The pandemic being a health crisis, but it reflects itself into markets. Now, you're going to see a lot of historical headlines around it, etc. And there's two thoughts to it. I mean, in the one sense, your debt should be, percentages of, and I mean, South Africa's threatening to hit 70%. We've got the midterm budget policy statement from Minister Mboweni next Wednesday, which will give a whole bunch of details around where we are sitting and heading to go. We've got a number of G7 nations, Italy, Japan, and others who have debt in excess of 100% of their GDP. And then, of course, there's a deficit myth, which is a book came out earlier this year, and it's thinking is quite simply that why do we stress this? The point with it, what is that debt being used for? In the case of the US, it's been used for stimulus packages, a couple of trillion. They're talking a deficit of 3 trillion, but they poured 2 trillion into the economy. And so that money circulates into the economy. It gets taxed both as either at payroll or at corporate tax. It gets taxed at federal tax levels. It generates jobs. It keeps businesses going. So there's a lot of debate around whether we should stress around sort of debt to GDP as much as we do. Traditional economics says this is an absolute and unremitting disaster. But there's a lot of evidence that says, hang on a second, it's actually not bad. The concern is often inflation, but we have seen in places such as Japan and even in the US where inflation is just not the problem. It might become down the line. We need to do something about it at that point. But perhaps inflation is way more of a scary beast than the debt to GDP number. So there will be, as I said up front, a lot of fairly historical headlines around the end of the world. And as always, it probably isn't the end of the world. What we do have is, at this point, no stimulus package for the US. President Trump, at one point last week, tweeted and said it's off the table. Then he said it was back on and he wanted it to be bigger than what the Democrats wanted. Current numbers are about 2.2 trillion for Democrats, 1.6 trillion for Republicans. Democrats have passed something through the House, but it can't get through the Senate. And at this point, certainly it looks like confirmation hearings for new Supreme Court justice are starting in the US today. And I think the focus is probably going to be on that. I think it was just last week that we're ticking down to an election, and I would have thought that an election would have perhaps speeded up the process of getting some stimulus, but this apparently not happening. And remember, the stimulus ended back at the end of August, so we now sort of call it 6 weeks, and we're seeing the hurt. We're seeing airlines laying off staff. We're seeing hotel groups laying off staff. We're seeing Broadway remaining closed until May 2021. We're seeing Disney laying off staff. There's certainly still pain happening, but I'm not sure it's going to happen. And then, of course, the risk is Biden wins, Trump couldn't be bothered, and actually it waits until January of next year. Moving across to the, in fact, let's stay in the US quick. JPMorgan says US capital gains tax hike, which is proposed by Biden, may briefly hit stocks. If we go back to the 2016 election, there was a lot of fear from the markets around a Hillary Clinton win. They'd kind of got used to it. Clinton was about a 75% odds on to win. And just let's go down that rabbit hole quickly. Everyone's saying, the prediction, not the predictions market, but the sort of polls and stuff were wrong. Well, no, they had Clinton at 75%, which means hold that election 4 times and Trump will win once. Hold it 100 times and he wins 25 of those 100 times. Currently, those numbers are running at Trump winning 14 out of 100. So they've got Biden at about 86% chance of winning, which means there's a 14% chance that Trump effectively wins. Back in 2016, a lot of concern around tax increases and the like if a Democrat won, and those issues are on the table. I mean, certainly unwinding some of Trump's tax cuts, and I think probably less so for the sorry, take a lot orders being confirmed. Probably less of a concern in terms of the corporate tax. That's going to be, I think, harder to roll back on. But certainly tax for high earners, we can see that coming. Capital gains tax definitely on the table. So there are concerns around that. But the flip side of Biden and a possibility of a blue wave, which would include the Democrats taking the Senate as well, and then pretty much having unfettered control over the U.S. Economy, is that what you will see is a lot of stimulus spending. And as I was saying a moment ago, that's not necessarily bad for an economy. If we get that stimulus spending up and going, that can certainly help an economy a whole bunch more. So it's betwixt and between as to exactly how it will operate. But certainly markets are more sanguine about a Biden win than they were about a Clinton win 4 years ago. I think the bigger issue, and we're probably still going to see some volatility between now and the election. The bigger issue is, the vote is 3 weeks tomorrow. 3rd of November. Polls will close that evening. When do we get the result? And that is probably going to lead to some serious volatility as we wait for the ultimate result coming from the US. UK economy. So the UK, remember, oddly enough, well, not oddly enough, but of the major economies, they're the only one that does monthly GDP. Now, they flash numbers. The key focus, as always, is going to be on those quarterly or annualized numbers. But they did see economy growing by 2.1% in August. Expectation was for about 4.5%. 2 reasons why expectations were quite bullish. One was obviously low base effect because it's month on month, so it's August versus July. But also remember that the UK had their restaurant spending plan. So basically the government gave you money to go and eat in a restaurant, and you got discount if you did. And it was quite a significant chunk, and certainly restaurants had reported good activity, but seemingly that hasn't flowed into a broader economic return. So that is not insignificant. It's positive, and that is good news. But 2.1, particularly with that restaurant spending initiative, I think is actually quite a very light number. Robinhood says some customer accounts may have been a target of hackers. 2 important points here, and this is not markets, but it's not unimportant. The first is that it's not that Robinhood was hacked, it's that people reuse passwords. So you get hacked on site XYZ, but you've used that password and username on Robinhood, and hackers then go across to Robinhood and are able to gain access. The key point is don't reuse passwords. And this is a public service announcement more than anything else. Get a password manager like a LastPass. If you're on Mac, you can use Keychain. Heck, even Google Chrome will do it for you so that you have password. I don't know what my passwords are. They're all between 20 and 50 characters in length, and I don't know what they are. I just know the password into my password manager, and then it takes it all from the rest. So they can't draw money, right? Because the bank account is linked, and that's your bank account. They would have to go a lot further to register a new bank account, in terms of actually being able to get money out, and that is a lot harder with the FICA and KYC legislation that is applicable, not just locally but globally as well. So really the disruption more than anything is their ability to enter and exit trades. But the key point, don't reuse passwords. And then tomorrow, Tuesday, Apple is got an announcement. It's expected to be new iPhones. November, we will see new MacBooks with the Apple Silicon. Remember, they're moving to making their own silicon, and that will be what their first time that they're using their own silicon. And they moved to Intel. So maybe 13 or 15 or so years ago, where they've been since then. But new iPhones on Tuesday. It'll be iPhone 12. It'll be 5G compatible. And here's the thing: back in the day, way back in the day, sort of 5, 10 odd years ago. What the first one was 13 years ago. When a new iPhone came out, there would be queues around the block for them, and Apple would get a spike in the quarter that they're issued. So in this case, it's going to be Q4 for 2020 because of sales. Now, reports are that Apple's had some issues with supply chain, but they're still expecting around about a 75 million unit sales in this quarter, which puts them pretty much on par with previous Q4s. A lot of talk that they would get to 100 million, but they've kind of capped out. And there are a couple of points. And it's so the iPhone's not the big booster that it used to be. It's just kind of keeping that underpinning. And we've spoken a number of times on this podcast, and I've spoken elsewhere as well, about how what we're seeing is that Apple is very much the hardware is there, and they've got it, and they do those sales, and they've got the watch and the tablet, and they've got the computers, and of course the iPhone, but services really is their new business, and they've got that fight with Epic Games around the App Store and the like, and that's going to be messy, but also frankly somewhat protracted. It's going to take some time before it gets anywhere. But also that our phones, the changes have become, sort of slight changes rather than radical changes. And the phone, so the update cycle, which was for most people 2 years, for some people 1 year, there's still a lot of folks who are on the 1 year update cycle. But I think most of us have actually moved to 2, perhaps even 3 year update cycles, particularly as the phones have got a heck lot more expensive. First iPhone was $200. Now this iPhone 12 is probably going to be $1,200. And for an age, that iPhone was a $200 phone. And then they started to creep up, and they hit $1,000. And now more recently, they've gone through that $1,000. So certainly, the computer supercomputer that we carry in our pocket, and it is a supercomputer, but we pay accordingly at the same time. Moving to some local, so President Ramaphosa is addressing both houses of parliament on Thursday to unveil his economic recovery plan for the country. A lot of skepticism out there, particularly in the Twitter, saying, hey, you know what? Plans are great, we need execution, and I don't dispute that in the least. Keen to see what's in it. I think there's probably 2 easy wins. So the extra payments to social grants and unemployment have been extended to end of December. Will we see that extended still further? And then I think the key area is going to be in energy and infrastructure. Infrastructure is an easy win. It employs a lot of peeps, and it ultimately, infrastructure for an economy is good for that economy. And energy, of course, will be public-private partnerships. It'll be independent power producers. It'll be renewable energy as well. And again, good for the economy in 2 senses. One is just in generating more capacity. And I saw Sikanati, who is now spokesperson for Eskom. And I know back in his days when he worked at FinWeek, Business Day and the like. And he was tweeting around the usage. And admittedly a weekend, but we'll be using 27,000 megawatts of power. And that is a terrifyingly tiny number. we were using more power in 2007. Now, sure, there's a lot gone off the grid. Some households gone off the grid. We've put, smarter geysers. We've got better lights that use less power. But a lot and industry's gone off the grid. You'll see those the solar panels at the macro car parks, and a lot of other corporates and mines, etc., have been as far as possible gone off grid at the same time. But our economy is just, it's electricity usage is where we were a decade plus ago. And part of the trick is that if our economy started to boom, let's say, we're going to boom into next year, and that's just simply going to be a base effect. But if our economy grows too fast, we hit our head against load shedding, and that puts a brake on it. So we need these two, power generation and infrastructure are hugely important. The challenge, of course, is how do we pay for it? And Minister Mboweni, Finance Minister, does his midterm budget policy statement on Wednesday of next week. And President Ramaphosa can say a lot, but we need to pay for it. And that's going to be the real deal, is in terms of, okay, so here's the plan. Issues around executing on it, but where do we find the money? Now, I thought Minister Mboweni's budget back in Feb was a really, really good budget, with one caveat, that it included renegotiating already negotiated wage increases for civil servants and essentially moving those down. That has obviously got overtaken by the pandemic, and maybe more IMF money we'll see. Maybe also some tweaks to Reg 28. And before everyone gets paranoid around that, the trick with Regulation 28, and my understanding of what, if anything, is proposed, may be proposed, is not that they're going to force Reg 28 into SOE debt and that sort of thing, not at all. But that they, at the moment, when Regulation 28 compliant companies, your old Mutuals and Sunlums and Allan Gray's, Coronations and the like, are investing Reg 28 money, they can take that last sort of 10% and put it into what is called alternative assets. And that includes energy, that includes infrastructure. And I've spoken to a number of people in the industry who manage Reg 28, and they're like, we'd actually like that to be pulled out and stuck on its own. So that infrastructure spend perhaps as its own category, or perhaps energy spend as its own category, green energy rather than dirty coal energy. So we might also see some tweaks on that. So President Ramaphosa's speech on Thursday, important, and then follow up. I'm going to say as important. I don't know which is more important. As important will be next week when Mboweni talks and does his midterm budget policy statement, and gives us a sense of how we're going to pay for all of this. One of the ways, of course, of looking for companies that are going to benefit, PPC. We had results out from PPC on Friday, and truthfully, they were a horror show. Their losses are 5 billion. Their market cap's only 1 billion. Their debt is almost 3 times their market cap. On the day, the market quite liked it. Stock under some pressure today, down at 64 cents. I spoke with the CEO on my MoneyWeb podcast this morning, and about a rights issue potentially. And he says quite simply that the DRC has US dollar debt, and that debt has a claim to the business, to the PPC South Africa, and they need to resolve that issue, and then they'll look at a rights issue perhaps in March of next year. So I think almost certainly we will get a rights issue, but it's probably 4, 5, maybe 6 months away before it actually lands. He also commented that they'd seen some demand pickup, and part of that is pent-up demand, and that the dumping is still happening. 18.30 to the dollar is when the dumping is just no longer viable, but at 16.50 it certainly is. So we've still got challenges in this space, but if President Ramaphosa does come and Minister Mboweni brings the money, PPC could be a highly speculative but a potential play here for infrastructure spend. I mean, infrastructure is going to use a lot of cement, a lot of concrete, and that could play into it. The other stock I really like in this particular space, of course, is Afrimat. Hit new highs back in just under a month ago, come back a bit since then. They're putting one of their sort of subsidiary businesses into business rescue. That's not a massive deal really at all. But Afrimat is well positioned. Now, both Afrimat and PPC have got competition. PPC have got Supaku, but of course there's Lafarge, who are unlisted in the space here. But they don't directly tender. Those tenders are won by third parties who then approach the PPCs and the Afrimats. And I remember speaking to Andres van Heerden from Afrimat a couple of months ago, and he said he was seeing unprecedented tender activity already. So these two should both do really well. Now, Afrimat is not cheap. PPC is cheap. PPC absolutely with a high risk there. I mean, if they can't resolve that 150 million out of the DRC, I'm not quite sure. I don't know what they do then. I mean, what is the plan? Do they just put the DRC into business rescue? The challenge with that, of course, is quite simply, if the DRC goes into business rescue, is there's a claim back to sort of the PPC group, which then could create some issues there. Multichoice news that got everyone excited last week was that Canal Plus took a 6.5% stake in Multichoice. That was announced. Was it Monday? Yep, it was Monday morning that got announced just ahead of the open, and owned by the French TV channel. A lot of excitement that perhaps they were going to come and do a potential takeover here. And I don't think so. Firstly, we've got media control rules. Foreigners can't own more than 20% of a company owning a broadcast license. Now, Multichoice could restructure their holding. Multichoice obviously holds DSTV, South Africa, and then other operations. They could do a restructuring. They could spin off the rest of Africa, and maybe it's a JV at the Africa level, or rest of Africa rather than at South Africa because of those restrictions. But I think probably more a partnership, which doesn't necessarily need much more equities changing hands. And what I mean by that is that Canal Plus is obviously very much French language, and therefore very active in Francophone Europe, sort of the Francophone Africa, sort of North Africa, where French is the language, whereas Multichoice very much in Anglophone Africa, where it's English. There's a bit of crossover there, but I think they could perhaps sort of agree to a less butting of heads, and perhaps sharing some content and agreeing, to not enter certain markets. And there's a weird thing around competition rule, and we see it particularly in the tobacco companies, right? So, if you're in country and you decide to carve up a market, geographically or whatever the case is, competition commissions the world over come swooping in and say, whoa, hang on, can't do that. But if you do it on a global level, it's a whole different game. And we see it with British American Tobacco, Reynolds and others. Well, Reynolds now owned by BTR. And how they've broadly carved up planet Earth, but rather, so they do regions. And I wonder if Multichoice and Canal Plus couldn't sort of do some regional cooperation through Africa, where they simply say, look, we almost won't compete against each other. We'll take certain markets, dividing it between French speaking and English speaking, and then sort of pause off each other. So I don't think that we've necessarily got any sort of delisting happening here, but certainly what we do have is potentially some sort of deal between them. Spur update last week got markets very excited, and it was truthfully a very positive update, and Spur has responded accordingly. Hit some resistance here at around the 1640 odd level. If you can break through that, could get up to 1750 or even maybe 1920 rand. In essence, updating on restaurant activity. Now, if we look at this column on the side here, your May activity, which of course was quite bleak. I mean, the Hussar Grill down at 0.2%. Rockamama's at 47, which is, that was as we were moving into level 4. We could order ourselves some Ubers and the like, and certainly activity there. But the average for the group in May was 14.3, and this is at a restaurant turnover as per the year, same month the year before. And that's now up to 74.8%. That's a significant improvement. Now, make no bones, 74.8 is still only 3/4, but it probably, my sense is through the point where the restaurants are now probably profitable. Not massively profitable, but profitable. Hussar Grill coming in at 93.7, which is huge. What surprised me was pizza and pasta right down at 63.2. I would have thought pizza and pasta would have been that's really your takeout. That really fits into Uber Eats and Mr. Deliveries and the like. We've seen Rocamamas, which obviously really kicks into that, doing really, really well. Management state that it exceeds expectations, that this is way better than what they had been expecting and hoping for at this point. But here are the questions, and we see a fairly big jump from for all of the months, but certainly from August to September as we moved into level 4 on the 21st, sorry, level 1 on the 21st of September, but level 3 in the first 3 weeks, getting my levels wrong. Level 2 and then level 1 from 21st September. So 3 weeks trading at level 2 and then a 10 days trading, 9 days trading at level 1. How much is a pent-up demand? How much is it that people are just sick of cooking their own meals after 6 months? So today is day 200 of lockdown across the 5 different levels in South Africa. So is this perhaps just pent-up demand? We need to see the October, the November, see it into December as well to get a sense of how much it is. But what it's also showing us is that there's been a lot on the Twitters in particular and in the media and the like around, restaurants can't survive at 50% occupancy levels. Well, somehow at 50% occupancy levels, the SAR Grill's doing 93.7%. That's head scratching, but the point is that number there. But what it does show, and perhaps this is even the more important, is it shows confidence of South Africans who are prepared to venture out with their mask and their sanitized hands and go to restaurants. And that perhaps is the really, really big story here. Now, we're seeing some numbers rising. KZN just had its worst day on Sunday since, early September. Etc. Perhaps into August. I can't remember. I had a look at it early this morning. It slipped my mind. But it does show some levels of confidence coming back to consumers. And that's important. That confidence is also around revenue. Now, of course, a lot of people have lost jobs during this lockdown. Some of those jobs are back, but many are not. A lot of people have had salary cuts. Some of those cuts are back, but again, many not. So that confidence is not just a health-related issue. It's confidence about your income. Are you confident that you will continue to earn? Are you confident that your job is safe? Are you confident that you're going to continue earning? So what we're seeing, what this tells me more than anything, is a return of confidence. And that, to me, is perhaps the most important point around here. We also saw some media stuff over the weekend. The Spur, late last week, the Spur chairperson, because, of course, they've lost the CFO, CEO, and COO in fairly quick succession, saying, nope, nothing to worry, don't stress it, all is going to be okay. Maybe, but certainly, in some senses, I suspect that that's probably what he needs to say regardless. First Rand Bank, I said FNB, but actually it's First Rand Bank, have issued 20 exchange-traded notes on 10 different US traded instruments. Now this actually lists beginning of the month. I only picked it up last week. This is frankly quite a biggie. So what we've got: Tesla, Netflix, Microsoft, McDonald's, Facebook, Coca-Cola, Apple, Amazon, Alphabet, which of course is Google, and then the iShares MSCI Global Developed ETF. And we've got two versions here, Qs and Cs. So you see Tesla, Qs and Cs. Qs will have no currency impact. Cs will include currency impact. But what this gives us is an ability to, now if you're a high net worth individual and you've got a brokerage account, you've got a web trader account and you've got your money offshore, well then this doesn't serve any purpose to you. Except of course, Amazon is a $3,500 share. What's that? 55, 60 odd thousand ZAR. So maybe Amazon's out of your reach. Maybe you don't have an offshore account. It just, the numbers don't work for you. Well, now you can get that exposure, either in the currency neutral or the currency impact one. You can buy it in your normal JSE account. So, but this is really aimed at the private clients. Although I was speaking to Becky and Kizi from FNB last week. And he was saying they've actually seen some interest coming from funds as well who want to drop them in, and they're going to be bringing out more of these. They're going to look at some Asia as well, maybe some Europe. I think the focus is predominantly going to be on the US, and it's tech stocks with, as I say, 2 consumer stocks in there, McDonald's and Coca-Cola. But I think this is great innovation. This really does enable us via a JSE account to get nice and easy exposure into some of those hot stocks. So, and on Twitter, a lot of people were complaining that they're not tax-free compliant. They're not, because these are issued over individual equity. That is true, but neither here nor there. And a lot of other folks were saying, but they're expensive, in terms of valuations. Sure. But there is choice, and maybe one day they won't have expensive valuations. It's the choice which to me makes it massively important. There are market makers, as you can see, market makers setting spreads at typically around 10 cents, sometimes 15 cents. So decentish, that's 1 to 1.5% at a market maker fee, and the Cs will have a 1% annual fee. The Q's not. So I like it. I think this is great innovation. I think it's a really, really great product, and we'll see what the others are that they bring to market. You can see here I've got a watch list rolling. If you're looking for the cents, it was published on 22 September, so you can go find those cents and the details. They are ETNs, so they expire. Expiry is September 2025. There are 3 options on expiry. One is thanks for playing and shut it down and give your money back, which you'll get net asset value for it. 2 is extend the terms, and you can extend the terms twice, so they could extend it. And 3 is issue a new one and roll you from a September 25 into what I suppose will be a September 30, etc. I expect that those that are popular and have got market cap, etc., will probably see them extend the duration, and perhaps they could push that by a decade to September 2035, which is miles far away. Yeah, really, really great, and I like it, and I think this is a great product from First Rand. And you don't need to have a First Rand brokerage account. A lot of people were thinking you needed to. You can buy this in any brokerage account. Question coming through, not tax-free, correct? Yeah, correct. You can't buy this in a tax-free account. And that's because they are individual stocks and because they are ETNs. And then last on my list today was Baldwin results out this morning, just ahead of the market open. Well, 7:30, well ahead of the market open. Baldwin was all over the news last week because President Ramaphosa was at their Multichoice development outside Pretoria, which he was opening. What that is I think is it 30,000 units ultimately, and it's public-private partnership. A PPP, and what that is that government is paying for the sort of services, which is your sewerage, your roads, etc., and then Baldwin pays for top structures, which they then sell. The results out of Baldwin, which were the 6 months to end August, obviously we saw massive pressure on revenue, down 35%. I mean, they were literally unable to sell for a couple of months. Profit for the year off 56%. Interestingly, they did declare a dividend, and they're sitting on a fair bit of cash. And in fact, they increased cash. Their cash is 427.7 million. What Baldwin is interesting space. They've got some developments in the higher sort of plus 2 billion. Billion. I keep on doing billions when I mention Baldwin, in the plus 2 million rand space. But a lot of their units are the sub 1.5 million, and we're seeing a lot of buying activity in that particular space. And that's because of interest rates at prime at 7%. So a lot of first-time buyers coming into the market. So a lot of activity happening in that particular space. And that plays directly into Baldwin. I'm going to chat with them in my MoneyWeb show tomorrow morning to get a sense of how that activity is doing. They're also now doing online sales, which is weird because one of the red flags for KYC is if someone buys a property without having seen it. But of course now we've got pandemic. And in many senses you might have seen that unit and you buy the other one because they're broadly going to be the same, etc. We'll get a sense of how that trading is doing. It's certainly an interesting stock. It's run quite hard on last week on the Multichoice. Getting a valuation on this at this point is perhaps a little bit tricky. The stock in of itself is actually at 1-year highs. Okay, so it's not quite, it's back to July 2018, so it's at 18-month highs. But contrast this with Calgro M3, which for a long time was my preferred stock in this place. Now, Calgro's in a slightly different space where they are typically doing cheaper homes, and they do it in conjunction with government subsidies. And I suspect they're probably running into issues into that regard there. If we see the trading update, they're actually expecting to move into a fairly chunky loss. Now, a couple of years ago, when, in fact, well, back here, I imagine around this point, so mid-2018, I had held Calgro, and I did the classic. I exited them. I exited like 80% when Nene got fired back here in December 2015 at huge profit, and then I keep a little bit left, and I don't know why. And then I finally got rid of them at $10 roundabout here. So Keith McLaughlin from Alpha Asset Management have run some numbers, and we figure that the land back then was probably worth around R9 a share because they got land banks. And even if we discount that markedly, we come in at say R4.50, maybe R4 a share. Tells you you've got nice discount here. But the question comes is what's going to unwrap that discount? What's going to fix it? And that is the challenge part. Of the two, Baldwin and Calgro, after years and years of me preferring Calgro, I think Baldwin is better. But I do think we might see some weakness here. If we look at Quantum, now what was the Quantum Food Group? Is it QFG? No, Quantum Food Holdings. There it is. Yeah, that massive spike. I mean, someone sold their Quantums at 11.50 and change. Of course, someone bought them all the way there. It's now come back and settled. There's obviously, what we can see here is there is someone at $6 who is happy to pay for Quantum at $6 and has been now. So there was a seller at $6, and then the seller obviously got their full quota, and now there is a buyer at $6. So Quantum is that pullback from the spike, and that spike is, in a sense, looks a bit like the Baldwin perhaps in time. So I wouldn't chase Baldwin at this point, but if you're interested, I would certainly put it on a list, and I would start to get interest maybe sub 380. It might even perhaps get down back sort of to the R3 or so. The 420s might be a little bit pricey for the Baldwin right now. And that, folks, is a slightly shorter truncated. As I said, no Dineo. She was having some tech challenges, so no Dineo this morning. But we will get back to normal resumption of service next week. Remember, we've sent out the new updates. We're back with the Wednesdays. For now, Fridays we're going to be changing, but the Wednesdays are back. I'm going to be looking at the two new Satrix ESG ETFs that they listed back in September. This particular Wednesday, I quite like them. I think they certainly got some great innovation there in the ESG. There's some challenges around ESG. We'll talk on those as well. And then, of course, Mondays as per normal. And then a quick housekeeping. Week of 26 October, which is 2 weeks' time. I am going to be at the beach for that week, so no shows that particular week. And then normal service will resume through November through to mid-October. Ladies and gents, everyone have I see some questions coming through. Give me a sec. Let me move that over to there. Let me jump to the questions. Julian, comment on transaction capital. So I like transaction capital is the short answer. I think their taxi business is really, really solid. I think the management team is great. When an asset when they sold one of their businesses, someone offered them a 21 times price earnings for their business, and they were like, yep, you can have it. It is yours. I don't see the massive synergies with the We Buy Cars stake, which they've taken. I'm not convinced by that. Maybe in time I'll be proven wrong. I know what they think the synergies are in terms of with SA Taxi and the like. I'm less convinced. In the immediate, obviously some challenges around taxis. How are they faring, etc., etc. But broadly, I like the transaction capital. Richard, what is the FNB ETN's codes? Yeah, so the codes are messy. Let's pull one of these up, buy it. So you can see the code there. So it's TS for Tesla. It'll be NE for Netflix, MI for Microsoft and so on, FB for Facebook, and then it is ETN, so it's 2 letters for the stock, ETN, and then .Q or C, so 6 letter. But if you go to that sense on 22 September, Richard, you'll find it all there. It is a little bit messy, as I say. Simon, you're asking for an ETF for properties. There is. We have local and we also have offshore, depends which you're looking for. There are a couple of them. So there is STX Pro, which is the Satrix Property Index, with some tweaks to it, but you've got so that is local. You've got, what is the core shares one? CSPROP, perhaps maybe just as simple as that. Yep. So this is the core shares one is waiting on the use of yield as a weighting component. And then we've got the offshore ones, GLPRP, and there are a couple of those. This is the S&P. Is it S&P? I think it's S&P Dow Jones Global. And it's the 40. Signia also offers a offshore property. There it is. Same underlying altogether, and then I think Satrix might have an offshore as well with some tweaks. So property's been hit hard, but Keelan Gluvo did a presentation for us at Just One Lap last week. If you go to justonelap.com, you'll find it on the homepage. Scroll down; it's on the right hand side. And he is, I wouldn't say he's bullish on South African property, but he's certainly very much of the view that the worst is probably behind. He thinks there's certainly some activity that could be happening there. He probably still prefers the offshore property space, and certainly, work from home are challenges, debt levels are challenges, loan to values are challenges, and REIT status. All of those are various different challenges. But Keelan was, I suppose the phrase I would use is cautiously optimistic, and truthfully, more so than I would have thought. I was surprised by his level of cautious optimism. Ladies and gents, we'll leave it there. We'll chat again next week. Everyone, stay safe. Have a good week further. We'll chat again next week. Cheers all.